first thing we're going to do is talk about the different types of annuity. There are 4 basic types of annuities that you may run into. There are 3 that we actually sell or help advisors to sell. So a fixed annuity, or what you refer to as a MYGA, and that stands for multi-year guaranteed annuity. Okay, so that's an annuity that is going to pay 5% for 5 years, or 7% for 10 years, or whatever it is. It is as plain as they come. It is as simple as they come. It doesn't do anything other than pay that interest rate. It has a minimum interest rate, and it has that interest rate stipulated for a term. Now, it may pay that interest rate for the first year. It's a 5-year contract. It pays 5% for the first year, and years 2 through 5, it renews at whatever the applicable rate is. Okay, so different derivations, but that is a basic plain vanilla annuity contract, a multi-year guaranteed annuity contract. A single premium immediate annuity is a little bit different. Client puts a single premium as the name denotes. The immediate portion is that it immediately begins paying income. So I put money in, and it's going to pay me income out, and it's going to pay me income for a set specific period of time. Okay, that could be 5 years, it could be 10, it could be 20, it could be lifetime. Now, in a single premium immediate annuity, when that term ends, so it's going to pay out for life. The person who sets the contract up, it's going to pay for their lifetime. They pass away in 2 years, the money is gone. They live for 45 years, they keep getting a check for 45 years. Okay? A variable annuity is not something that we sell, but there are a lot of people that have them. A variable annuity is an annuity contract where the investment options are called sub-accounts, and those are clones of mutual funds. So it's not in the mutual fund, but it works just like the mutual fund. Why the difference? When somebody invests in a mutual fund, they're one of however many people invest in that mutual fund. And when anything happens with that mutual fund, value goes up, value goes down, they have to change holdings based on their prospectus. It affects everybody that's in that mutual fund. The cloned version of that mutual fund, i.e. the sub-account in a variable annuity, it is just for investors in that variable annuity. It mirrors the larger fund, but it only impacts the people who own that variable annuity and have money in that sub-account. Now, what's a negative aspect of a variable annuity? Well, unlike the fixed annuity contract or the fixed indexed annuity contract, which we'll get to, a variable annuity can lose money. Variable annuities also charge pretty high fees. So this is going to focus just on fixed indexed annuities. You see this little disclaimer here. This information is basically what we're covering is generic stuff about contracts in general. If you are going to explain to someone an indexed annuity product, you want to make sure that you have looked at what that company actually offers. Okay? So generic terms, the product as an overview, as a whole, as a type, but this information is not meant to take the place of anything from a carrier. Okay? Fixed index annuities are not a securities product. First and foremost, they're not invested into the stock market. They're not invested into an index. They credit interest based on the performance of an index. So the index is something that is tracked. There is a growth in that index, and that's used to create an interest rate that will be credited to the indexed annuity product. Okay? It is not invested in the market. Client funds can go up, but they can never suffer a loss. Even if there is a double-digit loss, the client earns zero. They stay where they are. Okay? That is protecting my money against losses, against market risk. These are the basic terms and the basic provisions inside of a fixed indexed annuity. There are guarantees, there's all of these things, and we're going to cover each one of them, okay? So the first is a principal and interest guarantees, okay? They offer a guarantee of the funds deposited and interest credited. So when the contract makes a gain, that gain is locked in, okay? Provided the funds are kept in the contract for the duration or the contract term. So if it's a 5-year contract, you gotta leave money in there for 5 years. 10-year contract, you gotta leave money in there for 10 years, because that's what governs the guarantee, okay? If it's a 10-year contract and you take money out in year 7, well, the guarantee is based on 10 years, okay? Pretty simple stuff, but when you start getting into the minutia of the contract and start talking in contract lingo, this stuff becomes a little blurred to your prospects. You want to keep things as simple as I'm keeping them now, because believe it or not, your client doesn't want you to impress them with your knowledge. They want to understand what you're saying, right? The only person that most of the people you talk to want to be impressed by the knowledge is the surgeon or the doctor that they're talking to, who's explaining to them how they're going to save their life or fix this problem, right? This does not require you to get into a high level of trying to impress them with your knowledge if you are showing them how you can help them solve a problem, okay? An indexed annuity is a unique investment option for clients looking for growth, but unwilling to risk their principal or suffer losses. And John mentioned, if you have clients that are over 65, 65% of them want to create income, but how many of them are willing to risk their principal? I don't know too many people that are retired that are willing to knowingly risk their principal. Okay, so that's one of the provisions of this product. The term is often referred to as a surrender period. Okay, it is a period of time that the client must stay in the contract in order to back up the guarantees. Okay, now what that makes this is what I refer to as a time contract. Okay, now the guarantee is tied to the term, which is the same way any product that offers a guarantee functions. So people will say, well, I don't want to put my money and leave it there for 10 years. That's no, because they think like the company's doing something mischievous by holding on to their money. Well, if you have a 5-year CD, how long do you have to leave the money there? 5 years. If you have a 10-year treasury bond, how long you got to leave the money there? 10 years. Why? Well, because if you take it out before then, what do they have? There's a penalty. So an annuity, an indexed annuity, is not unlike any other product that offers a guarantee for a set period of time. And if there's one takeaway from this whole thing, this is something you want to take away. When you talk to people about annuities, and the biggest objection is going to be, it's a 10-year contract. I can't leave my money there for 10 years. Well, number one, they can take money out penalty free, right? There's an amount that they can withdraw penalty free. Most every contract has that. But the reason that the term is there is because that enforces the guarantee, and it's the same as any other investment product that offers a guarantee, okay? And when you tell people it's a time contract, and then you refer to a CD or a treasury bond, it will make sense, right? It's on a level playing field. It's not like the annuity is this anomaly that's out there all by itself. It's this 3-headed devil, and it's the only thing out there that's going to make me keep my money there for 10 years. Doesn't work that way.
It's kind of like a handshake. The company says, hey, you leave us your money with us for 5, 7, 10 years, and you just work within the provisions, but we will guarantee that you'll never have a loss. but you'll always have a gain when the market goes up, and your gain will always be locked in at the highest level. So it's kind of like a handshake. You do this, I'll do that. You do this, I'll do that. And so that's kind of where I kind of tell my clients, if people have that same concern that, oh, they're going to have my money for that long. No, no, no. There's a lot of, you can access your money, but you have to understand that the annuity carrier is guaranteeing quite a bit that the marketplace can't. So I just wanted to throw that in there. Okay.
Yeah. Thank you, John. Thank you. For those of you that know John, and I know many of you on this call do, John can get away with the handshake explanation. I cannot. I can't. If I tell somebody it's like a handshake, they're going to look at me and say, I don't know. That's why I developed the comparison to the other types of products, right? If you have that demeanor and that gift that John has, run with his handshake. If not, then go with my, because hey, I don't know. I guess I just don't endure. I don't endure that same level of trust that John does. Okay, there are products that have a monthly point-to-point, an annual point-to-point, a 2-year point-to-point, and all the point-to-point means is I take my contract out on February 20th, that's today. So if it's a monthly point-to-point, then it'll look at March the 20th, April the 20th, right? If it's an annual, then it looks at February 20th of 2026. If it's a 2-year, February 20th of 2027. And that's the period of time that they measure to see where that index that it was tracking, what it did to calculate your interest, and then your interest is credited on that date. It's very simple to explain. The indexes. This is the index that it's going to follow. The S&P 500, the NASDAQ, the European. There are so many indexes now. It gets to be a little bit much, perhaps, to figure out what each contract and carrier offers. But as I mentioned earlier, I mentioned Ryan's name. Ryan's on this call. So do you have to know all about the crediting methods and the index options and all of the other things we're going to cover here shortly? You need to be able to explain it to your client. But when it comes to picking, what's going to be in a contract, that's what Ryan can help you with, or John can help you with, until you get to that point where you feel more comfortable with the understanding of the contracts. And then the niche options and the other things that are out there, again, those are all things that Ryan can highlight for you, and with the various sales tools, show you how those things could work based on what it is that your client's objectives are, right? So again, it is all geared around what is the problem the client wants to solve, how is that problem solved best, and working in conjunction with Ryan to come up with the best solution for your client. Index annuities typically do not charge any fees. The client puts $100,000 in the contract is issued, there's $100,000 there. But they do all offer optional benefits, and some of them require a fee. Again, this is something that Ryan would be able to explain to you, and he'll even ask, or it's on, in some of in the annuity illustration request form, there are questions about different features that you want included, right? But some products have a return of premium. So if I cancel after a certain period of time and it's before the surrender charge, then I get my money back. But they charge a fee for that, right? Or a guaranteed roll-up rate, which is I've got the income rider on the product, and I'm going to earn X% every year towards that, okay? This is not that you need to know all of this stuff today. A lot of this stuff are things that Ryan would go over with you. And if you have a question about any of these things, you can call me, you can call John, you can call Ryan, and we'd be happy to cover that information with you as well, okay? So one thing to know, I know that everyone wants to feel confident in what they're talking about. And through these 6 weeks or so, we'll equip you with what you need to have a better level of confidence. The only way to really increase that is to do it, right? And we're not gonna do, when I asked my dad that I wanted to learn how to swim, my dad took me and threw me in the deep end of the pool. And you either swim or you sink. So that was my, we're not going to do that to you guys, right? We're not going to say, okay, now you have this information, go out there and start selling. But we can begin to have conversations about prospects. We can begin to have conversations about specific clients. And I think I would like to do this with that client. And these are things that I do every day with advisors. Talked with an advisor yesterday about a client. This is what she was thinking she wanted to do. And she talked with Ryan and got some information and some illustrations. She talked with me. We talked her through. Ryan talked her through. And that's what we are here to do for you, okay? Income writers offer, they charge a fee sometimes they don't, but they offer guaranteed income. And the guaranteed income continues even if the contract drops to zero. Why would the contract go to zero, Sean? You said they can't lose any money. Well, if they don't make a lot of money and then they spend and get the income over a period of 10, 15, 20 years, perhaps they will have spent all of their money. But the income rider guarantees that that income will continue for as long as they live, typically, or until the age of 95. If they had their money in a mutual fund account or in an equity portfolio or in a variable annuity that did not have an income rider, which most of them do not, then when they ran out of money, they'd run out of income. And a simple question to ask many people when you're talking about income, if your account went to zero, you've got an account with Edward Jones. If your Edward Jones account went to zero, are you still going to get a check every year? And they'll say no. Wow. If your Edward Jones person said, if you leave the money with me for 10 years and I only charge you 75 basis points to guarantee that you'll get income even if your account goes to zero, would you do that? And most people would say, well, they give you one of two answers. Yes, of course I would, but it's not available, or my Edward Jones guy can't do that for me. Well, guess what? You can if you get them an index annuity contract with an income rider. So you see, there are ways to talk about these things that take it back to not I'm selling you a product, but I'm talking about problems that you have and I'm telling you how this will solve it. And it boils down to two things: income, guarantees of my principal, without losing any money. There are long-term care riders. Why? The odds are that 3 out of 4 people are going to need some type of long-term care benefit. And there are two kinds. It just pays a monthly benefit, or if they have an income rider that they're collecting income from, that income could be double during a period where they're needing care. There are some more nuances, again, that Ryan could cover with you if you have a client who has this type of a need. How do you know if my client has this type? You ask them, do you have an extended care plan? There's a document we have that we can get you that it basically is someone is creating a written plan for what happens to me if I need extended care. So again, all of these things tie back into uncovering a problem, okay, and showing them how this is going to be a solution to that problem. How does a simple example of how an index annuity works? Client invests $100,000 into an index annuity. Policy is issued on April 30th of 2023. Annual point-to-point, S&P 500, 100% participation rate. What does that mean? That means that 100% of what the S&P 500 earns, that is used to calculate the credited interest rate. And an 8% cap, what does that mean? That means that the highest amount that's going to be used of that S&P 500 increase is 8%. So the S&P 500 grows by 20%, the contract value is 108. Why? I got 100% up to 8%. It grew by 20, so I get 8. What if it grew by 4? I get 100% of 4 because 4 is less than 8, right? It is not always that simple with every contract, but that is a basic generic explanation of how it works. And what did your client do? Well, the client says, well, I could have made 20. I lost 12%. Your contract is crappy. No, Mr. Client, you traded some of the upside potential for protection against downside risk. So yeah, you only made 8, the market went up 20, but next year if the market's down 10, how much will you be down? 0. So it's not a short term, and it's a 10-year contract. Everything cycles all back around, everything fits together, okay? So this is very simple, and that is the way I would explain it to someone. You're trading some of the upside potential for downside protection. What other people sometimes say is you only go up, you never go down. Again, it sounds a little bit too good to be true, right? I got to give up something. You are. You're trading some of the upside potential for downside protection. Each contract typically offers an annual reset provision. So every year on the anniversary, the product resets to wherever that value of the contract is and wherever that index is, okay? That locks in gains, creates a new starting point, and protects against market volatility. If I'm invested and I have 100% of my money just in the S&P 500, not in an indexed annuity contract that's tracking the S&P 500, but it's just in the S&P 500. And it starts out at 1,000 and it goes up to 1,500. Well, that's where I am now because I'm just invested in the S&P 500 in an S&P 500 fund. Okay, I started at 1,000, it goes up to 1,500. If it loses 600 points, it goes from 1,500 down to 900. Okay, I lost in the S&P 500 just in the pure index. I lost all that money. And I'm now below where I started. I started at 1,000, now I'm at 900. So in order for me to get back where I started, I've got to earn 11%. And in order for me to get back to where I was at 1,500, I've got to earn a lot. The annual reset provision in an indexed annuity prevents any of that from happening. So if I had the indexed annuity, it went from 1,000 to 15, I made my percentage that my contract gave me. It goes from 15 down to 9, well, it resets at 9. I don't lose my gain, but now I start from that point, and if it goes back to 1,000, I made money because all my money was there. There's a simple graph that will show you, many of you have seen the simple graph from an annuity. It's in our presentation next week, but that's basically how that works. So trading some of that upside potential for downside risk, but I'm locking in those gains, and every year I'm starting from whatever that point is. So again, I'm not hamstrung in a down market, which is a pretty important feature because everyone knows there are going to be ups and downs in the market. Okay, so that brings us to the end for today.